Risk assets continued to suffer in September despite the sharp losses that were seen in August. Commodities were the biggest loser, with all sectors, including the safe haven gold, suffering sharp declines. Core government bonds in Europe continued to make gains, particularly as the yield on the German government bond fell to a record low level of 1.65%. During the month, concerns over the euro sovereign crisis weighed heavily on the euro, as it suffered declines against both the dollar and the pound. The Eurozone sovereign crisis continued to play out, centring on the sustainability of Greece's debt burden. The debt swap programme that was agreed through the EU and IMF package in July allowed for a 20% reduction in Greek debt. Expectations are that at least a 50% debt write-off would be necessary to bring Greece's debt back to a sustainable level. The impact of this type of restructuring is unknown, and to date markets have been disappointed by the associated policy reaction. The euro has fallen against the dollar from 1.44 at the start of September to 1.33 at the end of the month, while the yields of Spain and Italian debt have also increased. The effects have also spread to the banking sector, notably the French banks, who were significant holders of Greek government bonds. To date, the ECB has continued to provide liquidity to the EU banking sector, while a collection of global central banks are loaning dollars to the Eurozone banks. Elsewhere, the various governments around Europe approved the new EFSF changes that were agreed in July. The economic picture remains mixed, particularly after the IMF became the latest to cut its outlook for economic growth. This weaker outlook has prompted the Federal Reserve to provide additional assistance for the US economy. It has extended the maturity of its bond portfolio in the hope of keeping interest rates for long bonds lower. Obama has also proposed an additional jobs programme costing as much as $447 billion that will be funded by increased taxes for the rich.